Well,
And free, and free, and free, and free.
I've seen that.
Everybody getting on right now is like, what did I walk into? This isn't the sales meeting I'm used to. Well, I will go ahead and get started. How dare they start recording? Now this is all on tape. I apologize, Jen. Next time you leave town, I'm going to do a better job. So, so let's get started. I'll open it up and welcome everybody to sales meeting. I'm really excited to have you guys here. See a few more are trickling in. So first, wanted to address wants and needs. If you guys have any buyers or sellers you want to tell us about that you think we could collectively help you with, go ahead and take it away. If there's no wants or needs, we'll continue, but I'll give you another 10 seconds to decide. I count fast, that's 10. All right, we'll move on. So we're gonna do our broker moment right now. So multiple property buyer is what we're gonna talk about today. Do you have a buyer that buys multiple properties from you throughout the year? Does one exclusive buyer broker agreement work for those multiple properties? Anybody wanna be brave enough to answer? So I will say word on the street, and obviously everything's up to interpretation in real estate with contracts and whatnot. But word on the street is you need a new one as soon as the transaction's over. So the buyer broker agreement does expire upon the purchase of a property and you need a new one. So I think that's good to know. Some of us work with investors. I once helped a guy that bought, I think, 15 properties from me in 1 year. He was a flipper. This was back when you could actually buy a flip property off the MLS. But yeah, we had to get a new buyer broker agreement from him after every transaction. So keep that in mind so you're not breaking any rules, because if you go and offer on a second one after that one, you're technically offering for an unrepresented buyer, which none of us want. Are there any questions about that?
Yeah, Brian, one question I have is on that. So I know the BBA you typically have to do over, but what about like the wire fraud disclosures and things like that? Can that be reused or not?
I would be safe and redo it, because anything that has a date on it, you want to show that it's fresh and you redisclosed.
Cool.
I got to compliment you on those glasses, though. I'm going to go and try and find a pair of those. Those are.
Hey, they're only $20. It's any optical, so it's easy to find. Easy to find.
You're making me break the rules. I'm not supposed to envy, and I envy those. So we got upcoming classes as usual, plenty of CE. So hope to see you guys all, of course, at my champions training. Or actually, this is last time. So obviously we've got the Mondays champions training. This Thursday, actually tomorrow, we're going to be doing death and the transfer of real property. This is actually a really cool course, and it's awesome that it's CE, but this is something you'll run into. And every time I run into an agent who's doing this, they call me when I'm their broker. I don't think I've ever had an agent just do one of these transactions. They've always had to call me about something, because it is confusing and there's stuff that you need to know. So if you can make it, I would highly recommend you get over to that class. And I guess that's next Thursday. I was a little bit confused, but we've got our regular sales meeting next week, mindset and marketing, and of course, Monday's champions training. Some of you might not know this, but champions training goes from 10 to 11, and then 11 to 12, we have an Ask the Coach hour. So if you don't want to come to training, but you have something you need help with, be sure to log in at 11. We have Ask the Coach hour every week. So congratulations to this week's closers. Going to give you guys a round of applause. 39 closings. It's a really good sign. I don't know if you guys were paying attention, but as a brokerage, we had a few weeks there that we were just hitting 10, 20, 30. So this is just as an overall sign of the market and more listings popping up, just seeing how successful we're being and getting back up towards those 40 or 50 closings is awesome. So great job out there. You guys are killing it. We're way above the average as a company per agent. So you guys are doing really well. Weekly cappers, we have Lori Butterfield. Congratulations to you. That's an amazing accomplishment. And then announcements. I don't know if there's anybody on here that wants to say anything about the paper shredding event. If so, just interrupt me because I'm not the one who put it together, but we do have the paper shredding client appreciation event on April 23rd. Call Casey if you want to buy in. It's not too late. You could send out a text to 50 or 100 of your top SOI in one afternoon and let them know it's happening. It's not something they have to schedule out a whole evening for. They can just show up, get their stuff shredded. We were kind of surprised. I kind of thought it was like a desperation event during the pandemic. We're like, what can we do? But we had such a good reaction and people coming back and saying, when are you doing that again? I've got my mail piling up here. So definitely worth it. Get your people out there, and it's something to actually provide value for them. We also have agent headshots. So sign up now for your headshot on April 28th at 1 p.m. in the Pleasant Grove office. I would say you should probably also call Casey to set that up, just to make sure that we know how many people are coming so our photographer can schedule out the requisite time for it. So I'm going to turn time over to our affiliates. I'm not sure if Amy's here, but we'll start with White Knight Insurance. If she's not here, I'll give her a quick shout out. You with us, Amy? So just as a reminder, make sure you talk to Amy about the great deal she can give you as a Presidio agent. She does home and auto, and she surprisingly kind of saved a deal the other day. I didn't know insurance agents had anything to do with the deal, but one of our agents called and said that Amy saved a deal for him, and the lender said the same thing. So that was pretty cool to hear that. So give her a call, see if you can save any money. I saved quite a bit. I know Jen saved quite a bit when we switched over. So I'll turn it over to Patrick Murphy with Home Warranty of America. Go ahead, Patrick.
Hey, thanks, Brian. Appreciate it. Hey, just let everybody know that I will be in attendance at the Shred It Day from 11 to 1 on Friday. Please come by and just introduce yourself to me and greet me, because not everybody's in the office when I come in there, and it's hard to kind of meet you face to face. So I'd really like to get to know you. Just a reminder that it's all about value, the things that I can provide for you and your clients. So don't forget about that free sellers coverage. I mean, it is free, guys. So yeah, it's great value. It has a $1,500 cap with it, and sellers can, utilize that if something goes wrong during the listing period. It's a great value, and I'm here for you guys. I'm working when you're working. So give me a call. Thanks. Appreciate it, Brian.
A quick shout out to Patrick. We used to have a home warranty company, and they specifically told me not to push the listing coverage because they lose money on it. So I'm super impressed that you guys are actually telling us about that, because it's really impressive. When I tell my seller, hey, I'm going to warranty your house for you, let me know if anything breaks, then they're just like, wow, can't believe you're doing that.
Quick anecdote. We had a listing coverage on for a seller, and their refrigerator and their dishwasher went out on them. And we fixed the washing machine. It was a washing machine, not the other thing. And then the refrigerator we couldn't replace because of the COVID deal. So as a courtesy to the homeowner, and I did not facilitate this, my company just sent the seller a check for the balance of what was the $1,500. I think he got a check for $1,366 after we fixed his washing machine. So he was able to go out and buy and it was just a little cheap $500, side by side. It was not a very expensive refrigerator. And so he was able to pocket some money there. So it's a great company. We've been around a long time. So look forward to helping you guys.
Thanks, Patrick.
Thanks.
All right, go ahead, Jack. Take it away.
Hi guys, for those that don't know me, I'm Jack Andrews with Edge Homes. Wanted to touch base on two things. One, every Tuesday we release multifamily, that's condos and townhomes. And so I currently have about 20 available units combined between those two product types. And then every Wednesday we release single family. And so I will have about 15 lots coming up tomorrow available to offer on prior to Thursday at 5 o'clock. So give me a shout on any of those. Reach out to me anytime. Just call, text, or email. And then I wanted to address issue. People have seen the KSL article where a builder has basically canceled people's contracts because their costs have been rising, their direct costs being lumber and concrete and fixtures and flooring and OSB composite boards and all that stuff. That's a legitimate thing. In addition, if a builder wants to replace what they are selling, they have to increase prices in order to purchase land at today's prices to do that. So a combination of factors have just made it the costs tremendous to Edge. And I want to underscore two things with Edge Homes. Number one, we pay a 3% buyer's agent commission on the lot, on the premium, on the home, on any over asking price that your clients do, and on upgrade options. That has always been the case. I am told that will always be the case. It's in our DNA. And then lastly, we are honoring our contracts with our clients. We are not renegotiating 30 days prior to close. We are not raising price. When they go under contract, they are locked in, not just the contract price, but also their options pricing at the time they go under contract, and that won't change. So reach out to me. Let me know if you guys have any questions, and I appreciate you.
I got to give one extra shout out also to Jack, because I'm sure all of you guys have noticed the pain of builders going down to 2%. It hit my back pocket a few times, and it's awesome that Edge remembers who got them where they are, and they're not just kicking us to the curb because it's convenient and they can do that now. So you guys rock. Thanks, Jack.
Thank you.
All right, I don't think Paul Wynn is here. Him and Braxton are the Luneta Home Loan team with Brighton Peak Financial. I'll just give them a quick shout out. They saved 2 deals for me in the last 3 months. The lender I usually use told me the deals could not be done, and Braxton and Paul got them done. One of them they closed in like 13 days because we came to them like a week before closing. We got a week extension. They closed it in like 13 days. So they're doing a great job impressing me every day, and hopefully they make it to one of these meetings so you guys can meet them as well. All right. So with that, we will turn our time over to Jeff Metcalf from Presidio Real Estate, our educator extraordinaire for the day. We're excited to hear what you got for us, Jeff. Take it away.
Awesome. Thanks. So guys, I want to apologize. My computer won't work for some reason. I can't get my password working. So I've got to do this from my cell phone. And I think you guys all know how taking a Zoom meeting over cell phone is. So it's not great, but it's all good. We'll deal with it. So one thing that I was asked to talk about is just about LLCs and S corporations. So one, there's something I want to just kind of give it as an example first, just to show that this is very complex. Like it's not as easy as saying, hey, this is the way to do it. This is how you do it. And, you know, with my role within like IRA accounts, at my current employer, so my day job, you know, with IRAs, I can say to everybody, hey, do a Roth IRA, but no, that may not make sense to everybody. That's the same with taxation on things, right? So an example is so with my current employer, we have master limited partnerships, right? So it's a stock that basically is traded on the New York Stock Exchange. And these master limited partnerships can elect the taxation that they would prefer. Okay. So most master limited partnerships would be taxed as a partnership. The reason that they do that is it makes them a flow through entity, right? So they can actually flow the gains, losses, everything on the position down to the individual investor, as opposed to having to put it all on their books. Okay. Well, if that partnership then says that they want to be taxed as a corporation, then they don't have to flow this all down. The actual tax reporting is very different. So with a partnership, they get a K1, a Schedule K1. With a corporation, they get all of their information reported by their broker on a 1099. So how things are reported are very different. And so I just want to make sure that we understand that, you know, there are intricacies here where, you guys, I'm not a tax advisor. I don't ever want to be a tax advisor. So just so you guys know, like I don't know all the intricacies of everybody's situation. And so kind of take this as more knowledge of, okay, what benefit does this provide And then, you can talk to your tax advisor and see what is the best answer for you, right? So I think in large part, the overarching benefit to an LLC would be that you are protecting your basically assets from any type of litigation, right? So if you create an LLC and you have some type of issue come up, you guys, that could be really any regulator that's basically coming against you. Your liability, your assets are protected, right? Your personal assets. So all they can come after is your business's assets. Okay. Any questions on an LLC, just in general, just so you guys know, it's a limited liability corporation, just if anybody doesn't know that. But any questions on that just to begin?
I have a rumor that you might be able to dispel for me. I've been told that if you're the only owner of the LLC, that your personal assets are still a little bit in danger. But if you have another minority owner of 10% or more, they're more protected. I don't know if that's true or not. Wanted your opinion on that.
Yeah, so technically the LLC protects it, but that's the thing is anytime you get into these type of issues, they're going to have to drill down and see what it is. And I would say, yes, if you're a sole proprietor of the LLC, then you could have your personal assets at bay. But that's why we're going to talk about how to kind of structure it where, if you have multiple people, it definitely helps. And that's the thing, like, you guys, if you have an LLC and say you're married, just make your spouse as a minority owner, and then that protects you. And so that's where I would say, yes, you can have it come in, but the main driver of the LLC is to separate those assets, separate. So if you do have litigation, it kind of protects your personal assets. Brian, does that help or not dispel as much?
No, that's good. And sounds like we'll be covering stuff that will make that not matter as much. So good to go. Thank you.
Yep. And just so you guys know, so with an LLC, you have an LLC is an actual entity, right? You'll hear the term S corporation. Now, let's just understand that is not an actual entity. Okay. This is a tax classification. So remember when I said with our master limited partnerships, they could have a tax classification as a partner or like a partnership or a corporation. Now that affects how things are reported. But when you have the S corporation, that would basically be a tax classification that you assign. And that would affect how you're going to be taxed on your income from the business. Now, there are some things to note though. So with S corporations, the IRS actually dictates that if you are a part of an S corporation, you have to pay yourself a reasonable salary. Okay. Now, what that number is, that's kind of tough to define because it's really what the IRS is going to tell you it is. And that's where I would say, talk with the tax advisor about that, of what that reasonable salary is. Essentially what the IRS is trying to do is they don't want you to either get profits or losses and just be able to take that all in. They want a salary to be paid to the owner or the shareholder. And that's one thing to note is when you have an S corporation, all the owners are considered shareholders. Okay. So you could have an S corporation of 1 to 100 owners, which they would all be technically your shareholders. Any questions? All right. So one thing that I wanted to mention is the reason to be able, like, to have this make sense is, we all look at kind of how we're taxed, and obviously when we're paying different taxes, we want to pay less, right? Well, what setting up this corporation would do is it prevents a double taxation. Okay. Now let me give you an example. So, and I'm going to relate this to the IRA world just because that's what I know really well. I've been, in the business for about 13 years. So I understand what it is, but what we have is in the IRA world, you have two main types of IRAs, right? You have a traditional IRA and you have a Roth IRA. Okay. One is tax deferred growth, which is your traditional IRA, and one is tax free growth, which is your Roth IRA. Okay. If I had a traditional IRA that is tax deferred growth and I move that money into a Roth IRA, I have to pay taxes on the money that moves into that Roth IRA, right? So at that point, I've paid my taxes, but then you guys, we have clients say this to us all the time, and it doesn't make sense to me. It actually blows my mind a little bit, but I will have people that will say, hey, can I move my Roth IRA back to my traditional IRA? And the question I have is, why in the world would you ever do that? Because now you're moving into a tax deferred account instead of tax free. When you pull the money out of the IRA, you're going to have to pay taxes, right? So that's an example where I would say you could put yourself in a position of double taxation. Now, at a corporate level, double taxation, it's a little bit different. But that just kind of shows you that, you know, you set things up to kind of protect yourself from taxes. But you guys, you got to understand, it's not tax evasion that we're looking for. It's tax avoidance. There's a difference. Tax evasion is illegal. Tax avoidance is not, right? But that's where I would say, you know, check with your tax advisor to see what kind of mimics your situation the best, because there definitely are benefits. And I'm going to go through kind of some pros and cons of the S-Corp, just so we can have an idea of what that means. But before that, I just want to see if there are any questions around this, anything that I can provide that's a little more detail for you guys.
I don't know if anybody's thinking this. If I didn't know the answer, I would be wondering. So could you explain the difference between tax deferred and tax free?
Yeah, absolutely. Yes. So, and that's related to IRAs, sorry, but yeah, so with tax deferred, essentially what it is so how traditional IRAs work is when you put money into a traditional IRA or you contribute to a traditional IRA, you have well, I wouldn't say obligation. You have the right, okay, that you can deduct that amount from your taxes. Okay. So say this year, the limit on IRA contributions, I believe, is $6,000. So you could go and you could put money into an IRA, into a traditional IRA, and you could put that $6,000 in, you deduct it from your taxes, right? So that $6,000 is kind of your baseline. But then once you actually take the money out of the IRA, so when you're retired, you take that money out, you pay on the full net amount, right? So you didn't have to pay taxes on the amount to begin. Now you pay it on the amount when you're taking it out of the account. But you're not, so you guys, would you have like a regular taxable account? If you go and you like trade stocks, you make money off of your stocks, everything like that, you're paying taxes on those actual capital gains. But within an IRA, you're not, because it's a tax sheltered account. And so you're just paying on the full amount at the end for a tax deferred account. Okay. With a tax free account, it works a little different, where you are not able to deduct that amount from your taxes. But when you take money out of that Roth IRA, when you retire, you pay no taxes on that amount. So I could take 50,000 from my account and I won't pay any taxes on that amount when I'm retired. Okay. Now, with IRAs, there are restrictions, right? If you take it out early, you have an extra tax that you have to pay, but you can take out contributions at any time. So that's kind of your tax deferred versus tax free, just kind of as an example. Does that help?
Jeff, does that include the interest that's being earned in that account for all those years?
That it's tax deferred?
Tax free or deferred,
yes.
Yeah.
So both, yes. So when you build that money, you just pay on the full amount that you take out of the traditional IRA. So you're not paying on the interest year over year. And then on a tax-free, you don't pay any money. So that's why it's called tax-free growth, is you can grow your account. And then once you pull it out of the IRA, the Roth IRA, you're going to have no tax liability. The only time, go ahead. Sorry.
That's like in the long run, a way better deal because you're going to appreciate that money with interest.
So it is, so there's kind of two things. So with tax-free, it definitely is. It depends on really your look on what you're going to be in retirement, right? So like if I'm going to be in a lower tax bracket and I have tax deferred growth, and not paying tax now and paying it later might make more sense, right? But if you're making more money, if you're going to make a lot of money in retirement, then yes, that would be great. So that's the thing, is there are complexities, and that's where I don't want to say a blanket statement. Me being, 36 years old, I would say Roth IRA all the way, but that I don't know everybody's situation, so I can't really say that. But that's where I would say, yeah, it depends on each person's situation, and it really depends on what you're hoping for in retirement. If you're hoping on making a ton of money, then yes, Roth IRA, because you don't want another tax liability coming. But if you think you're going to project it a smaller amount of money where your tax bracket's going to be lower, tax deferred might be the way to go. So awesome. Brian, does that help answer the question? Any other questions on that?
No, I just assumed people would want clarification, so wanted to make sure. Thank you.
Awesome. Cool. And then, so one thing that I wanted to say around the S-Corp, you guys, is there may be articles of incorporation and certificates required and they can be both on the federal and state level. When you're setting up those corporations, you'll need an articles of incorporation. Usually when you set up an account, like with the broker that I'm at, when we set up a corporate account, we actually have to have those articles of incorporation. Now, remember, that's for the actual corp itself, but this is a tax classification. So that's where it would depend on what the federal, so the IRS, and what each state would require from a tax classification. All right, so I'm going to go through just a few pros and cons that we can just and we can talk about if you guys have any questions. So pros with an S-Corp is the business pays your salary. It also, and it has payroll taxes on it, but it may save you money on taxes, because with the regular LLC, you would pay self-employment taxes and on the business's gross income. Okay. So that's where an S-Corp can help you. Now, a drawback to that is there's a salary cap. Okay. So remember, there's going to be reasonable compensation for the owner employees. So we would have to determine what that reasonable compensation is. And, like Brian had said earlier, with an LLC, he was talking about, protecting yourself from like having your personal liabilities or assets at stake in a litigation. So he's saying to create a minority owner. Well, if you do that in an S-Corp, you would have to have a reasonable compensation for that other owner as well. So just understand that there is a little bit of more complexity in kind of how that works. Also, one con that we can look at is, you have one class of stock technically when it's an S-Corp, and there's only 100 shareholders that you can have, right? So, that is a limitation. I would say from the benefits, pros and cons, I would say the benefits outweigh that, but that is something to keep in mind. Okay. Also a pro on the S-Corp is additional earnings are distributed to shareholders as dividends. Okay. So this may also save you money because those dividends are taxed at a lower rate as opposed to income. Now, you guys, I'm hoping that this is kind of helping you guys understand what the differences are, but also understand it is pretty complex, right? So it's not just something that, hopefully after this call, you guys don't say, hey, Jeff Metcalf said create an S-Corp, I'm going to do it, right? Like, there's a little bit more to look into just to make sure from a tax perspective. I don't ever want to have somebody call me and say, hey, I had to pay more taxes because of what you told me. So let's make sure we talk to tax advisors on this. Also, one more con is that share owners that own more than 2% of the company's stock can't claim employee health insurance as a tax-free benefit as they could with a C-Corp, right? So a C corporation would be a little bit different. But I think what we've seen from the S-Corp, there are some good things that are, can be used and would be beneficial. One thing that I wanted to just make sure that we understand is when we're creating these different structures, whether it's for a business structure or a tax structure, the whole purpose of a business structure is to outline who owns the business, right? How much of the business they own. Well, tax is the same way, right? So we would have these owners and what percentage is their ownership, and how do we need to basically flow that down to those owners and report it on the owner level. Okay. Any other questions, you guys? All right. So one thing, and Brian, hopefully you're okay with this. Hopefully everybody's okay with this, but that's the majority of like the LLC S-Corp benefit that I wanted to go through, just because there are a lot of complexities. I don't want to like guide us in one way and basically put us in a tough situation. But what I can do, if you guys would like, is I can review and go through some of the IRA training that I did in the past with the group. If there are people interested in learning more about IRAs, I'm happy to discuss. I know we talked about tax deferred and tax free, but there are actually more opportunities for self-employed individuals that I can help you guys on if you want to talk about that for a minute.
Well, I think the first person to speak up gets to decide, I guess. I'm not going to dictate because I want everybody to get what they need, but I personally would love to understand Roths a little bit more.
Okay.
But let's let everybody else decide, because
Awesome. Yep.
they're here for their education. Put it in the comments if you don't want to unmute yourself. Just either put Roth or what was the other option? Self-employed.
Yeah, well, I can talk about IRAs in general, so I'll be able to talk about Roth and self-employed and answer any questions. Yep.
I mean, what was the other option that you were willing to go over?
Well, so I have a deck for all of them, right? So I can go through what the difference between Roth and all those are to be able to give the self-employed options, but I can go more info on the Roth as well. Like I can do a deep dive into Roth, or I can do Roth, traditional, and self-employed IRAs together.
Well, it looks like we have a few people saying they want to learn everything. I think that for most people, unless I'm totally wrong, Roth IRA is, I mean, it's definitely the best way to save the most on taxes. So it might be interesting for you to give us a quick rundown on the difference between a self-directed Roth IRA and how to go about setting that up, and or just a representative directing the Roth IRA.
Yeah. So there are a few things. And I'll kind of talk about the differences between the traditional and Roth IRAs real fast. So as we said, there's tax deferred and tax free growth before, right? So the one thing that I would say on these though is with IRAs, if you have two IRAs, so like say you have a Roth and a traditional IRA, understand that the contribution limit, like the annual contribution limit, is for both of those combined, right? So you don't have, hey, I can put 6,000 into a traditional, I can put 6,000 into a Roth. It's the combination. Okay. Now, the one big thing that changed in the Roth IRA world is that there was a in 2010 there was a law that was passed where, so in the past, if you had a traditional IRA and you wanted to convert to a Roth IRA for it to become tax-free, there was an income limit. So if you made over $100,000, you could not convert to a Roth IRA. Okay. In 2010, the IRS passed that anyone could convert to a Roth IRA. Okay. Well, if you have a ton of money in a traditional IRA and you convert it to a Roth, that tax liability is going to go for that year. So if you're going to make a lot of money, you may not want to convert it at that time, but that's where it allows you to make up that tax-free earnings. Okay. But really what the basics are on traditional and Roth IRAs is you have tax deferred or tax-free growth, but you only can contribute so much per year. Okay. So right now the IRS had said that it's $6,000 per year. And then there's a catch-up contribution. So if people are over 50 years old, you can add $1,000 to that. Okay. So the limit is 6,000. If you're over 50, you could put in 7,000 a year. Okay. Now, the reason I say that I would bring up like self-employed IRAs is because the numbers are kind of ridiculous on how much of a difference it is. So if I set up a SEP IRA, which is a self-employed IRA, I can put aside $57,000 per year. I can contribute up to 25% of my compensation or $57,000 per year. Okay. Now that's going to be like a traditional IRA where it is tax deferred growth. Okay. But I can put a lot more aside. And then the simple IRA, which is also for self-employed, it's $13,500 per year. Okay. So there is a little bit more saving potential on those self-employed IRAs. But on the traditional and Roth, it's just more of like the basic vanilla kind of IRA account. What I would say though is like self-directed versus having someone take it over. So does anybody on the call, and you guys can either chime in or chat, whatever, does anybody have like a financial advisor that they use currently? Hey, Laurel, do you want to expound on your comment with the 2009?
Yeah, sure. I mean, I've had both IRAs since I was in my early 20s, so like 20 years.
Yeah.
And I think that statement's partially true. Like 2003 to 2000 and crash.
Yeah. Yep.
2009 were good years because it was slow, steady growth. It's not like we've seen so much of these huge swings in the last 10 years.
Yep.
And I think, obviously since the pandemic, if you've been in the market and you stayed in the market, you've done very well. But that whole period of like, there's been the years with like Obama as president were good in markets financially, but then the last few years have been really just kind of doing not much of anything, like up and down and up and down. So honestly, maybe I'm being pessimistic, which I do tend to do, but I think if you were just invested in the market, just staying in the things that you've been in over the last 10 years, and if you're strongly diversified, I don't think it's done so much.
So and this is actually kind of the reason I wanted to have you comment on that. So first off, the market over the last, and this isn't just the last 10 years, but over the last like 70 to 100 years, it averages 7 to 10% every single year. Okay. So that's not a ton, but when you look at the money you put aside, 7 to 10% is not too bad. And when you go to like the fixed income market on CDs, bonds, things like that, you're not going to find 7 to 10%. Like they don't really exist right now. But what I would say is, I agree with you. There are the ups and downs. And this is actually where I was just kind of talking, like thinking about a financial advisor is, so when we look at the market and we have our money in the market, we tend to use our emotions when we make decisions. Okay. So like we see it go up or down and we're like, oh no, I can't do this. So we pull it out or we put it in, whatever we do, but it's all emotional based investing. Right. And so with like, if you got like a financial advisor or even you had like a managed account, what those managers do is they stick to like a portfolio, man, the word's escaping me just a sec. They basically just have a composition that they stick to, right? So they say 50% this, 40% this, 10% this. And so that's where they are going to rebalance the portfolio throughout the year, throughout the months, whatever it is, to basically still go towards that investment objective that you have, if that's long-term growth, short-term growth, what it is. And so that's where I think there is benefit in having someone do it for you, in that the emotions are a little less there, you know. And that's where what I've found with investing, and you guys, I'll be completely honest, I can't invest a ton because I'm restricted by FINRA, that like I can only buy like index funds. But that's an anger point of mine, that I work for a broker. I've worked there 13 years. I know the stock market and I can't do it. So I'm like, whatever, it's all good. But what I would say is, when you have someone that has kind of seen it and knows it, it takes the emotion away. So you're not like just stress selling, you know, you're not saying, oh, I've lost $1,000, you know, because really you've got to look at what your approach is. Is it long-term or is it short-term? Me, for retirement, I'm looking long-term, right? But not for me, because I'll probably die at some point, but so my kids have money, right? Like I know I'm not going to live very long, and that's fine. But really it's looking at the term and duration of what you're investing for, that you got to kind of keep that in mind, because yes, with the ups and downs and the volatility, it actually gets very concerning. But what I would say is, you know, we talk like Obama and Trump and whatever. Trump was actually some of the best for the stock market ever. Like we've hit highs everywhere. Now, do I think it's sustainable growth? Absolutely not. I don't feel like the economic numbers backed up what happened on the stock market, but the stock market did move at a great rate. And it actually, a lot of people had a lot of money and got a lot of money from it. But when you look back in like the early 2000s, when the tech bubble burst, before that, you could throw money at a dartboard and you could make money, you know. And now it's taking a little bit more sophistication and knowledge to be able to find the places to make a little bit more money. Even though the market is going at a rate, you still have to find the investments that are going to do well. And so that's where I would say, kind of to Brian's point, there's self-directed versus having someone do it. Like if you get anxiety over the fluctuation, if you get worried, I would say have someone go ahead and take care of it.
I actually have someone who manages my IRAs.
Awesome. Perfect. Good. Let's see. Awesome. Thomas, that's great. Printing tons of money. I don't even want to get into that soapbox. I actually we're right on track for hyperinflation. So, oh well. But hey, Brian, was there anything else, or anybody else? Is there anything else like specifically on traditional or Roth IRAs that you wanted to know? You know, I can go as deep as you want. Like I said, I've covered the products for a long time. So I can even do more like a Q&A and just answer any questions on those account types.
I'll let everybody else have a chance to ask a question before I ask another one.
Okay.
If nobody has anything else pressing, I would love for you to talk a little bit about / maybe give us some direction on who to talk to about a self-directed Roth IRA. One
Okay.
one
Go
agent
ahead.
one agent came to me recently and he was asking about it, and I don't really have a lot of great advice on that. But he specifically was wondering what did he say? He was wondering what he could invest in, because he
Yeah.
was told by his tax guy that it'll be hard to find a custodian that would allow him to invest in weird things, is what he
Yeah.
said.
Yeah.
I don't
Yeah.
know I don't know what weird things he's referring to, but what are your thoughts on that? And if you can invest in things, will they just let you invest in whatever? And do you have a contact for us to call about setting those up?
Yeah. So I would say like I would kind of pin us in like the mass affluent space is how I would see it. But like Fidelity. So I worked for Fidelity for, oh man, how long was it? About 5 years, 5.5 years. And Fidelity is like the best, like, hey, if I want to do my own thing, they're the best to go to. Now within an IRA, you do have access to all stocks, bonds, mutual funds, everything like that. But what I think what the agent's talking about is a self-directed IRA. So within those self-directed IRAs, they will allow you to invest in like REITs, so real estate investment trusts, where, you know, obviously there's going to be a little bit more money in there because of it being focused off of real estate. The problem is the IRS doesn't really like you getting into that stuff. And so it is more of, you have to search to find the ones that are going to let you do the self-directed. I would have to look in my notes to remember which ones. But really what they would allow you to do, they would allow you to do those types of REITs. There are also alternative investments. Let me explain why the IRS doesn't like that. Those funds typically are less liquid, right? The concept of an IRA is about liquidity. Like that's what they want the IRA for. They want it for people to save. They want them to have access if they need to. Like obviously they want them to save for retirement, but they want them to have access. Well, with those types of funds, you don't have the access that the IRS would like. And so that's why they kind of restrict. But there are some brokers that will offer them, but it's all going to be based off of the actual charter that the broker has with the IRS on what they will allow. But I would say you go to Fidelity, you go to Charles Schwab, you go to like Morgan Stanley, E-Trade, anywhere like that, you're going to have the basic IRAs that you can go into. And sorry guys, I said E-Trade. E-Trade is actually like a subsidiary of Morgan Stanley now, so I don't know that I can really call it E-Trade, so sorry about that. But if you go to those places, they will have the IRAs that you can establish. You would have access to the stock market when you put money in. They would have a trading platform. They would have, basically all the research information that you need. And that's why I say even Fidelity is because I worked there. I know what research they have. And so that's where I would point people to. But, even within like Fidelity, they have different like advisory services where you can have a managed account within Fidelity. And you could either do it on your own, or you could have someone help you in managing that to be able to help grow your assets.
So is it safe to say that it's hard to find a custodian that would literally let you take out of the Roth IRA and go buy an investment property with it?
Yes, very hard, very hard. And it's because the IRS wants these to be liquid. Like that's what it comes down to. But yeah, it would be very difficult. And I'm not saying there aren't some. I think there are maybe 3 or 4 that I've heard of in the past. Now, do I know that they're still doing it now? I don't, but there are a few that I've heard of in the past. Correct.
the rules with buying an investment property through a Roth IRA are pretty intense anyway.
Yeah.
Like you're not allowed to lift a hammer. If you go and you hit one nail in, you're pretty much violating it. You're not allowed to take any of the monthly gains. And it almost, when I learned about it, it almost freaked me out enough that I just don't even want to mess with it.
Well, and that's what I would say on a lot of when they're tax advantaged or tax sheltered, the IRS is going to put everything they can to stop you from doing how would I say it, like creative financing. They will definitely try and stop you, because really what the IRS is worried about is they're worried about getting their money. And if you lose it somehow, then they would be worried about the fact that they're not going to get paid. If you put it in a stock, even if it's a speculative stock, the chances of you losing all that money isn't as grand as it is like an investment property or something like that. So that's kind of how it is. But yeah, the rules are very, very strict. And that's why when I talk about these corporate and tax structures, I want to be very clear that I'm not a tax advisor, and there are very complex rules that we need to know before we, jump and dive in. So
if why would they be worried about them losing money if it's if a Roth IRA is tax free? They're not going to get any money on that, right?
Well, oh yeah, true. That's right. I was thinking more traditional.
They're worried about having to pay you for retirement if you lose all your money, right?
Exactly. Yeah. I was thinking the traditional route, but yeah, with the Roth IRA, it wouldn't be as much that. It's just they want it in something liquid. But yeah, their rules, and there are because they'll have a list of like prohibited transactions within an IRA, that will cause problems, and we have to deal with that nearly every month where I work, where we'll have things that just weren't done and people don't know like the ramifications of what they did. And so we have to go back it out and clean it all up and tell the IRS why it happened and fix it, which is kind of painful, but there are plenty of rules to keep us at bay in the IRA world.
Right.
So, and one thing I would say to you guys is, I don't want to pitch IRAs way too much, but you guys got an extended deadline to May 17th, so you can still contribute to your IRAs this year. If you have one of those self-employed IRAs that I was talking about, you have until October 15th, which is pretty cool. So, and like I try to just let you guys know, like, I am always open to questions. I like to use my expertise. If I don't know the answer, I'll go find it. But if you have any questions around like retirement accounts or even investing in general, I'm happy to give, kind of my thoughts on it. I'm not going to give you advice, but like I can give you thoughts on how to look, how to research, how to do things like that. And, I'm always open to help with the knowledge that I have.
Awesome. Well, thanks. That's great stuff. It's I know way too many people that have decided to go and set up tax deferred or tax sheltered stuff in their 50s, 60s. And if the younger you can start, the better. Obviously now's better than ever. Let's have one more question, because I actually don't know the answer to this one. So obviously you can't take it out until you retire. I assume that means 65. So if you retire at 40, it doesn't mean you get to have tax deferred. So,
Yep.
But say you don't take it out and you keep on putting into it, can you continue to grow it tax deferred after 65?
So there are some limitations there, but not a ton. So with the traditional IRA, you cannot put in after you're 70. The reason is, it would be 72 now. So it used to be 70 and a half. Now it's 72, because that's when you have to start taking distributions. They're called required minimum distributions. You have to start taking those at 72. So after that point, you cannot put into the account, but in a Roth IRA, you can. And just a point of clarification is, once you hit 59 and a half, you can take out tax-free, because that's what it's not 65. They they put it at 59.5. So like, say you take out of your traditional IRA, you would still pay income tax on what you took out, but you wouldn't have the early 10% penalty on it. But even more to that, like if you contribute, you could take out contributions really anytime. If you only take out contributions, if you take out earnings or anything like that, that's where you get dinged with the penalty.
Got it.
So
Thank you.
awesome. Yep. Yep. Any other questions, you guys?
I'm good. Anybody else?
Perfect.
Well, thank you for the class, Jeff. We really appreciate your knowledge and expertise, and I'm sure you're going to get a few texts and phone calls today. So
Anytime. Happy to help.
you knew what you were getting into, right?
I did, and that's fine. So awesome.
Well, thank you guys, everybody, for coming to sales meeting. We really appreciate you. And I'm happy to stay behind for 5 or 10 minutes if you have any general questions. I like to do that after any class that I'm a part of anyway. So if any of you guys need anything, go ahead and stick on. Otherwise, we will call it a meeting and see you guys next week.
Awesome. Thanks, Brian.
Yep, have a good one.
You too.